Imagine someone at a dinner party casually saying they pay almost nothing in taxes while making billions. The ultra-rich play by rules most of us never see. Offshore accounts. Placing investments in offshore accounts may sound risky, but when structured correctly, it is a legal and efficient way to manage taxes. Many countries provide low-tax or tax-deferred environments, allowing wealth to grow faster before being taxed. Proper reporting ensures compliance with domestic rules, while providing flexibility to manage cash flow and timing of income. International diversification also protects portfolios from domestic economic or currency fluctuations. Offshore structures allow investors to access global opportunities while legally minimizing tax exposure. Transparency and legal reporting are critical. These accounts give individuals long-term flexibility, letting investments compound in favorable environments without immediate taxation. When managed strategically, offshore accounts become powerful tools for global wealth management, providing both protection and efficiency while remaining fully compliant with the law. Carried interest. Carried interest allows fund managers and private equity partners to treat part of their compensation as investment income instead of ordinary wages. Because capital gains are taxed at lower rates, this results in a smaller tax bill for potentially millions in earnings. It applies to compensation tied to asset growth, not labor, rewarding performance rather than mere work hours. Critics may argue it is unfair, but the method is completely legal and deeply embedded in tax law. Structured properly, carried interest reduces tax exposure while remaining fully compliant. It has become a cornerstone of modern investment strategy, letting professionals retain more of the wealth they help generate. This approach ensures efficiency in both compensation and long-term wealth accumulation while following the law. Stock options. Instead of getting cash, you might receive stock options. This can help you pay less in taxes. Here's how it works. You don't have to pay taxes on the stock options right away. You only pay when you actually use or sell them. This gives you the chance to choose the best time to pay taxes, which could help you pay less. Stock options can change your regular income into something called capital gains. Capital gains are taxed at a lower rate than regular income. If you're patient, aware of the market, and choose the right timing, you can benefit a lot from stock options. Many wealthy people and business leaders use this strategy to reduce taxes and grow their wealth. Stock options let your wealth grow over time without paying taxes on it right away. This approach gives you more control over your finances than just getting a paycheck. It's all about making smart choices and planning carefully to turn your income into a tool for saving on taxes, while also aligning your personal wealth with how well the company does. Life insurance, a wealth strategy. Permanent life insurance isn't just about protecting your loved ones, it's also a financial strategy. The money you put in grows without being taxed right away. In some cases, you can borrow from the policy without paying taxes immediately. When you pass away, the money paid to your family is usually tax-free. This makes it easier for wealthy people to pass on their money without having to pay heavy taxes. Life insurance can protect your family, help your investments grow, and plan your inheritance all in one. Wealthy individuals use it as a tool to keep their money safe and growing over time, passing it on through generations. It can also act as a flexible emergency fund, providing cash when needed without paying taxes right away. Loss harvesting, turning losses into opportunities. Selling investments that have lost value can help reduce your taxes. When you sell them at a loss, it can cancel out gains you've made elsewhere, lowering your overall taxable income. The key is timing. The losses need to happen at the right time to balance out profits and reduce taxes. This strategy helps turn bad market moments into smart tax-saving moves. While anyone can use it, wealthy people often benefit more from loss harvesting because they have bigger portfolios and more opportunities to plan. By managing gains and losses carefully, They reduce their taxes without affecting their overall wealth. It's completely legal and a way to turn market downturns into financial advantages over time. Tax credits, saving money with incentives. Tax credits are a way to directly reduce your tax bill. They are given for things the government encourages, like investing in renewable energy or restoring historic buildings. Unlike deductions, which just lower your taxable income, tax credits take money directly off what you owe in taxes. Wealthy people use multiple credits over time to save a lot on taxes by planning their investments carefully. Regular people might miss out on these opportunities, but wealth managers know how to take full advantage. Tax credits give you a legal way to reduce your taxes while also supporting good causes. For the ultra-wealthy, they're a key part of tax-saving strategies. Tax-deferred retirement accounts, growing wealth, tax-free. Tax-deferred retirement accounts let your money grow without paying taxes on it right away. You put money in before taxes, and it grows inside the account without being taxed until you take it out. Wealthy people often take advantage of these accounts in different ways to grow their wealth more efficiently. They can also plan their withdrawals for years when they have lower income, reducing their taxes. These accounts are more than just savings, they're engines for growth. Over time, your money multiplies in these accounts, and you don't have to worry about taxes on it right away. They're a powerful way to manage your wealth, both now and in the future. Municipal bonds, safe, tax-free income. Municipal bonds are loans you make to cities or states, and the interest you earn is often exempt from federal taxes and sometimes state taxes too. These bonds offer a safe, predictable way to earn money without paying taxes on the interest. Wealthy investors love them because they provide tax-free income and help diversify their investments. Regular people generally have to pay taxes on their interest. But with municipal bonds, you get a tax advantage. They're a smart way to make money while supporting public projects, like building schools or roads. For the wealthy, municipal bonds are an important part of a low-risk, tax-efficient income plan. Deferring income, delaying your taxes. Delaying when you earn income can help reduce your taxes. By choosing when you receive your money, you can take advantage of lower tax rates in the future or match your income with other deductions. This applies to bonuses, investment profits, or business income. Timing is key. Getting paid in the right year can save you a lot in taxes. Regular workers don't have this flexibility, but wealthy people often structure their contracts and finances to delay income legally. This gives them more control over cash flow, lowers their tax bills, and makes tax planning easier over time. When done right, deferring income is a simple but powerful way to save money and preserve wealth. Capital gains timing, choosing when to pay taxes. When you hold on to an asset, like property or stocks, and sell it later, you decide when to pay taxes on it. The longer you hold it, the more time your investment has to grow without paying taxes. You can also choose when to sell, often waiting for a year when tax rates are lower. Regular income gets taxed as soon as you earn it, but with this strategy, you can wait for the best time to pay taxes. It's like pausing the tax clock while your money grows. This strategy helps you preserve wealth and smooth out your income over the long term. For wealthy people, timing when to realize capital gains is a smart financial move. Step up in basis, passing on wealth without big tax bills. When you pass on assets like property to your heirs, the government resets their taxable value to the current market value, not what they originally cost. This eliminates any taxes on the growth the asset made over the years. It's a simple yet powerful way to preserve wealth. Families who plan ahead can pass on large amounts of wealth without triggering big tax bills. Regular people often face taxes when selling appreciated property, but those who plan carefully can avoid this. The step-up rule allows wealth to pass down smoothly, ensuring that long-term growth isn't taxed when it's inherited. Charitable giving, turning donations into tax savings. Donating money can actually help you reduce taxes. Wealthy people often donate appreciated assets like stocks or property, which lets them avoid paying taxes on the growth, while still getting tax deductions. Giving strategically can remove tax burdens while also supporting causes they care about. The size and timing of donations matter. For the ultra-wealthy, philanthropy isn't just about giving, it's also a powerful way to reduce taxes while achieving personal goals. Properly planned donations let wealthy individuals combine generosity with tax-saving strategies. Trusts and foundations, protecting wealth for future generations. Trusts and private foundations are long-term tools for managing and protecting wealth. By placing assets into these structures, owners can control how and when the money is distributed, while also delaying or reducing taxes. Assets inside these structures can grow for years without taxes. Foundations can support charitable causes while also providing tax benefits. Setting them up takes careful planning, but the results are significant. Wealthy individuals use trusts and foundations to protect their wealth, maintain stability, and ensure it's passed down the right way, all while staying within the law. Real estate depreciation, lowering taxes on property. Depreciation allows property owners to claim a loss in value each year for tax purposes, even if the property is actually increasing in value. These deductions reduce taxable income, which can result in substantial tax savings. For people with large property investments, depreciation is a key tool for managing cash flow and growing wealth. It encourages property investment by providing tax relief each year. Over time, depreciation helps protect wealth from taxes while the property continues to appreciate. It's a reliable, legal way for the wealthy to protect income and grow their real estate portfolios. Qualified small business stock exclusion, tax-free gains from startups. The qualified small business stock exclusion allows you to avoid paying taxes on large profits from small, early-stage companies, as long as you hold the stock for at least 5 years. This rule encourages long-term investing and can result in huge tax savings. Wealthy investors often use this to back startups, knowing that if they succeed, they can keep all the profits tax-free. Ordinary investors often miss this opportunity, but careful planning can turn risk into major tax-free growth. For wealthy individuals, this exclusion is a key part of building wealth and supporting innovation in the startup world.